A quick reminder that markets frequently react most dramatically to changes in expectations as opposed to expected events. Hi, my name is Rick Wedell. I'm the Chief Investment Officer at RFG Advisory. And today we're going to talk a little bit about how changing expectations can move markets in somewhat dramatic ways. Just to give everybody a quick sense of levels, the S&P 500 right about 75.26. That is up about 0.75% this morning, hitting a new all-time high, assuming that we stay over this sort of 7,500 level. Small caps, so Russell 2000 up about 16.7% year to date, so outperforming the S&P 500. And international stocks, all country ex-US, basically up about 12.3% year to date. Most of that driven by emerging markets as opposed to developed international. Emerging markets up about 20.6% year to date. The smaller countries in the world, China having a fantastic year as a market. I want to talk a little bit about what's causing the rally currently. Over the sort of longish weekend, we got some news coming out of the Gulf that both sides indicating that they may be closer to working out the terms of a truce. Somewhat of a framework had been reached on some issues, and then both sides kind of walking that back a little bit and saying, hey, there's still a lot of wood to chop here, but at least both sides indicating that there was, some common ground on some of the things that needed to be resolved to sort of reopen the strait. And I think that the reason why that's important is I think the market narrative had kind of shifted over towards the nacho trade, which is not a chance Hormuz opens. So you had seen that a lot over the course of the prior week. Traders sort of buckling down with this expectation that this was going to be a very, very long, drawn-out conflict, that we would not see the strait reopen anytime in the near term. And that may still be true. But what I think is interesting is that when that becomes the expectation, then when you get news that says, actually, this might be over sooner than you think, the markets react positively on the other side of that. When we were in, a couple of weeks ago, maybe even a month and a half ago, this expectation of this was a war that was going to last, 2 weeks or maybe another 5 days or maybe another 2 weeks. Any news that we got that suggested that, the war was going to drag on for longer impacted the market in a negative way because the expectation was this was going to be over very quickly. Now we're in more of a paradigm where I believe the market thinks that the war is going to take a very long time to get resolved. And when we start to get news on the positive, we see the market react positively in the other direction. And I think that that's just a good commentary on the way the market works. It's never really, when things play out the way you expect them to, the market doesn't really react all that much because it expected it. But when we get changes in expectations, that's when we see dramatic market moves. And that's one of the reasons why we talk about, how market timing is incredibly difficult to do. It's because the market doesn't really react to what you expect. It only really reacts to what you don't expect. So anyway, to go around the horn on some other things, we just note that earnings, season is pretty much wrapped up. Phenomenal earnings season, up about 27.5% year over year, well above analyst expectations for earnings growth of about 13.5%. And interestingly enough, valuation levels, if you think about the fact that earnings are up 27.5%, but the actual value of the S&P 500 only up about 10-ish%. That means that valuation multiples have come down. And part of that is due to the nervousness around what's going on in the Strait of Hormuz. Part of that is going into the fact that interest rate expectations have now remained elevated. We've moved from believing that there would be a rate decline to maybe there's a rate hike as soon as the into this year. And so there's some valuation factors that are driving that. But I would just note that if you were looking at just a pure multiple standpoint for the S&P, we are at levels that are really kind of median to below average for what we've seen for most of this decade, which is interesting. Certainly over the course of the past 2 or 3 years, that was not the case. One of the biggest wailing and gnashing of teeth that we heard was the fact that the market was trading at all-time highs. And I just note that the PEG ratio, price to equity growth, to earnings growth metric, which is basically just a way of saying, how is the stock market trading relative to analyst growth expectations over the next 5 years? That metric is actually negative right now, which is one of only a handful of times that stocks have been that cheap relative to their growth expectations. Now, some would argue that maybe analyst growth expectations are a little bit too rosy, and that's why you're seeing that metric flash in that direction. But I do just note this because I think it is interesting that when we came into the year, when we were talking in January, it was all about, stocks are wildly too expensive. Maybe harder to make that case now, given what's been going on in earnings and then as well on the multiple side and the growth expectation side. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.